So learning objective 3 is, it introduces you to the very, very first place that accounting actually physically takes place, which is called a journal. Okay, that's the first time. Um, this is where the numbers start in accounting. If accounting is a system of collecting and so forth, this is the very first bucket all the accounts and numbers are put into is the journal. But you've already done all the hard work. Learning objective 1 and learning objective 2 taught you how to analyze transactions and notice how the accounts are affected. And so, in essence, this particular objective relies heavily on what you've already learned from learning objective 1 and 2. Okay. So, again, if you look at this particular little illustration here, learning objective 1 and learning objective 2 were sort of covered in the analysis of a transaction. We are here. We're gonna, in fact, we're gonna get to this. This part's gonna happen the next time we get together. But all you're gonna be doing is actually being introduced to the journal, and all that analysis that you've done actually gets put into the journal, and you're going to learn that today. Okay. The journal, it lists everything, all transactions in a chronological order. And so you're going to see how everything is dated and put in. The idea that we're entering data in the journal is what journalizing is. So when they ask you to journalize, all they're asking you to do is put the data in the journal. And to illustrate how we do that, let's just take a look at our friends at Sierra Corporation. This corporation that we've seen in Learning Objective 1 continues to be followed here throughout the chapter. So on October the 1st, they issued common stock in exchange for cash. Now, you know what we did in Objective 1, right? We analyzed this. We said we had more cash. We had more common stock. Objective 2 forced us to say, okay, how do we save more cash? Where do we put that $10,000? So in the cash account, it goes on the left or the debit side. In the common stock account, it goes on the right side or the credit side. So you've done all the heavy work in that. Learning objective 3 is simply writing it into the journal, as you're going to see. Okay. Also later on the day, on October the 1st, they borrowed $5,000 by signing a note. We have more cash, we have more notes payable. We did the analysis there. Then you added your debit and credit analysis. More cash is on the debit side, more notes payable on the credit side. You've done a lot of this work, and now we're going to write it down. Sierra Corporation on the 2nd purchased equipment for cash. We have more equipment. You analyze that. We have less cash. You analyze that. More equipment happens on the debit side. Less cash happens on the credit side. And so now, how do these things look in accounting? Well, this is all the analysis. This is what the journal looks like. So journals will have, overwhelmingly, they'll mostly have 4 columns. This one has 5. The first column is the date, because everything is chronological, so the date gets put first. The second column represents the titles of the accounts. Now, those are the accounts that are affected by that transaction. Okay, and I'll tell you why they are listed in this order in a moment. This is not a column you'll see often. The reference column is not something you'll see very often. You don't have to worry about it right now. I will explain it next class. And then here's where the numbers go. 2 columns at the very end are the debit column and the credit column, and these are where the numbers go. Notice that the debit column is listed first, the credit column is listed second, very much like it would be in an account, right? When you look at an account, the left side is the debit side, the right side is the credit side. So the journal lists it this way as well. But what we have to do in the journal is understand that because the debit column is the first column the numbers go in, the account that has the debit is going to be listed first. So cash account is listed first because it's affected on its debit side. So whatever account is affected on its debit side is listed first. The account that's listed affected on its credit side is listed second in the account title. So here, again, we had more cash. We know that's a debit to cash. We have more common stock. We know that's a credit to common stock. That's all the analysis. This is what we put in the journal. Cash, $10,000 debit, common stock, $10,000 credit, period. That's it. That's what we're doing today. Okay. We borrowed money here by signing a note. We analyzed it. We had more cash. We had more notes payable. We know when we apply our debit and credit analysis, more cash happens on the debit side of the cash account. More notes payable happens on the credit side of the notes payable account because it's a liability. Right? So again, in our journal, the date goes first. The account that's debited is listed first. So $5,000 debit to cash was listed first. Notice how the indent here just indicates to the someone who's reading this, this is the account that was credited. That indent simply means that this is the account that was credited. Okay, so notes payable has a credit of $5,000, which makes perfect sense. That's all we're doing in the journal. On the 2nd of October, they purchased equipment for cash. We have more equipment. We have less cash. We know because they're both asset accounts, more equipment would happen on the debit side, less cash would happen on the credit side. So again, in the journal, we start with the date. The account that gets debited is listed first. So the equipment account is listed with a $5,000 debit. Cash account, again, it's indented for the $5,000 credit. And this is what journaling is. And this is what a journal would look like from those 3 examples that we just looked at. But these things are enormously long. They would be listed this way. The explanations here are not listed in real life, but they're listed here to explain to you, again, for you to remember what happened in the transaction. And that's it. The do it exercise that's listed here for you to review shows you what happened at Kate Brown's beauty salon. I love the name of it. Hair It Is Incorporated. I must have went to Kate's competitor, Hair It Went, because I'm losing my hair. And so it's a corporation. Inc. is incorporated. And so just like all corporations, they start because owners put cash in exchange for common stock. You're going to see this over and over and over again. It's very, very simple. It's very common. We have more cash. We have more common stock. How would it look like in the journal? We would debit cash 20,000, credit common stock 20,000. Notice there's an indenture here. Notice that this is the fake debit column and the fake credit column here in your imagination. This is how it's listed here. The second thing that happened here is they purchased $4,800 of equipment on account, which means they bought the equipment, but now it's going to be paid in 30 days. So you know what happens here when you buy equipment, you have more equipment. So more equipment is on the debit side. When you have to pay a bill in 30 days, that's an accounts payable, right? Accounts payable is a liability. Liabilities will increase on the credit side. So how would it look in the journal? Simply a debit to equipment for $4,800, a credit to accounts payable for $4,800. That's how it would look in the journal. The third thing that happened is they interviewed 3 people. Again, when you interview people, when you hire people, nothing has changed. And so this is not even a transaction and nothing has to get done. And that's basically what I wanted to introduce to you today. That's it. I mean, I just wanted to make sure we were sort of on pace to break it down. I wanted to give you this earlier. My best guess was to wait, let you sink in all that analysis first and see how it plays out. So I'll take questions that you might have at this time.